Most people think real estate makes money in one simple way: buy a property, wait, and sell it for more. While appreciation is one part of the picture, it's far from the whole story. Real estate is powerful because it generates income in multiple ways at the same time. Understanding how real estate actually makes money requires looking at the full system: cash flow, equity, leverage, tax advantages, and inflation. When these pieces work together, real estate becomes one of the most reliable wealth-building tools in history. Cash flow, the foundation of real estate. Income. Cash flow is the most straightforward way real estate makes money. It's the income left over after all expenses are paid. When a tenant pays rent, that money first goes toward operating costs like the mortgage, taxes, insurance, maintenance, and management. If anything remains after those expenses, that difference is cash flow. Positive cash flow puts money in your pocket every month. It gives you stability, covers unexpected costs, and allows you to hold property long-term without stress. While not every property cash flows immediately, investors prioritize it because it turns real estate from speculation into a business. Cash flow is also what allows investors to scale. That surplus income can be saved, reinvested, or used to qualify for additional loans. Appreciation is the increase in a property's value over time. This can happen naturally as markets grow, populations increase, and inflation pushes prices upward. It can also happen through forced appreciation, renovations, better management, or increasing rents. While appreciation shouldn't be the only reason to buy a property, it plays a major role in long-term wealth. Over a decade or two, even modest appreciation can dramatically increase net worth. The key difference between appreciation and cash flow is timing. Cash flow pays you now. Appreciation pays you later. Smart investors structure deals so they can benefit from both. One of real estate's most powerful advantages is leverage. Unlike most investments, real estate allows you to control a large asset with a relatively small amount of your own money. For example, putting 20% down on a property means you're controlling 100% of the asset, while the tenant helps pay off the remaining 80%. As the property appreciates, you benefit from the full value increase, not just the portion you paid for. Leverage accelerates wealth building, but it must be used responsibly. Cash flow protects leverage. Without income, debt becomes risk instead of opportunity. Every time a tenant pays rent, part of that payment goes toward reducing the loan balance. This process is called loan amortization, and it's one of the most overlooked ways real estate makes money. You're gaining equity without adding money out of pocket. Over time, the loan balance shrinks while the property value often increases. This creates a powerful wealth-building effect that compounds quietly in the background. In simple terms, someone else is buying your asset for you. Equity is the difference between what a property is worth and what is owed on it. As appreciation increases value and loan paydown reduces debt, equity grows. Equity can be accessed through refinancing, selling, or leveraged into new investments. This allows investors to recycle capital without fully exiting their positions. Unlike income, equity is often invisible. It doesn't show up in a bank account, but it's where many real estate millionaires are actually made. Real estate is favored by tax systems in many countries because it encourages housing and development. Investors benefit from deductions such as depreciation, interest, maintenance, and operating expenses. Depreciation is especially powerful. Even when a property is increasing in value, the IRS allows investors to write off a portion of it as if it's wearing down. This can significantly reduce taxable income, sometimes even eliminating taxes on cash flow. The result is simple. Real estate often earns income that is taxed less than traditional wages. Inflation reduces the purchasing power of money over time, but real estate benefits from it. As inflation rises, rents tend to increase, property values rise, and fixed-rate debt becomes easier to pay off with cheaper dollars. This creates a unique advantage. While expenses may increase, income and asset values often rise faster. Meanwhile, the mortgage stays the same. Real estate doesn't fight inflation, it uses it. Unlike stocks, real estate allows owners to directly influence value. Renovations, better management, improved tenant quality, or operational efficiencies can all increase a property's income, and income determines value. This is why experienced investors focus on properties with upside potential rather than perfection. They look for mismanagement, outdated units, or undervalued neighborhoods where they can create value rather than wait for it. Forced appreciation turns skill into profit. Real estate becomes truly powerful when investors use equity, cash flow, and leverage to scale. One property leads to another, then another. Over time, portfolios grow while systems replace effort. This scalability separates real estate from many side hustles. It can start small but grow into a long-term wealth engine that operates with minimal daily involvement. The key is patience, discipline, and reinvestment. Real estate isn't risk-free. Vacancies, repairs, market shifts, and poor management can turn good deals into bad ones. That's why education, conservative assumptions, and proper reserves are critical. The difference between success and failure often comes down to buying right and managing well. Real estate actually makes money in multiple ways at once: cash flow, appreciation, loan paydown, tax benefits, and inflation protection. Each on its own is powerful. Together, they create a compounding system that rewards long-term thinking. It's not magic. It's math, patience, and execution. Those who understand how real estate truly works don't chase quick wins, they build lasting wealth.